In the silver market, there are days when prices move because demand changes, and then there are days when prices move because the rules change. Late in December 2025, silver had one of those rule days. Reports tied a brutal drop in COMEX silver to a margin hike that pushed the cash required to hold a single March 2026 futures contract toward $25,000, up from around $20,000. Not months, not weeks. In a tight window, the cost of leverage jumped and paper positioning buckled. That's the part that breaks normal expectations. A market can fall hard without a mine shutting down, without a refinery stopping, without a single vault being emptied. It can fall because the plumbing demands more cash right now or you're out. And this is where it gets interesting because the story most people hear is a simple one. Silver fell because traders got scared. But the mechanics tell a different story. The mechanics say forced selling can be triggered by raising the price of participation. They said this could never happen in an orderly modern market. They said the exchange is neutral. They said price discovery is simply buyers and sellers meeting. But in commodities, the exchange is not just a meeting place. It's a system of leverage, margin, clearing, and delivery rules. When those settings move, the market can lurch like a plane hitting turbulence, and the passengers rarely understand why the cabin just shook. Institutions already know this. You don't need a secret memo to know it. If you trade size, you live inside the rulebook. You watch every notice, every parameter change, because those details are not footnotes. They are the steering wheel. And what I'm about to reveal changes how the last price print should be interpreted, especially when paper and physical start telling opposite stories. Welcome to Channel Name, where we decode what matters before it becomes a headline, and where we separate narrative from mechanism. If you would assist, you're the kind of person who listens to that wise elder who calmly points at the data while everyone else argues, you're in the right place. Drop a comment with where you're watching from, because this market is global, even when the rules are written in Chicago. Here's what happened in forensic terms. Heading into the end of 2025, silver volatility was already elevated. Then came the margin shock. Reports described the initial margin on March silver rising toward $25,000 per contract, from about $20,000 effective December 29th, 2025. In the same coverage, silver was described as sinking roughly 11% intraday. Think about that pairing. A mechanical increase in the cash required to hold paper exposure and a sudden violent move that punishes anyone who was using leverage to express a view. A 5,000-ounce contract is not a small instrument. In normal times, leverage lets a trader control that notional exposure with a fraction of the value posted as margin. When the exchange demands more upfront, the leverage shrinks instantly. And if a trader doesn't have spare cash ready, the solution is not a debate. The solution is liquidation. Positions get reduced. Risk is cut. Orders hit the market, not because someone changed their mind about the long-term future of silver, but because the account has to survive the next call. This is the central mystery most people miss. If paper selling is triggered by a rule change, does the selling reflect real supply suddenly flooding the world? Or does it reflect a financial constraint imposed on participants? Because those are very different meanings for the same price decline. Now zoom out, because this isn't new. The commodity world has a long memory. When a market runs hot, exchanges raise margins. It's framed as risk management, and in a narrow sense, that's true. Clearinghouses protect the system, but historically, margin hikes have also coincided with moments when speculation is punished and trend followers are forced out. In 1980, silver experienced a historic spike and collapse. The details are complex, but the rhythm is familiar. The market surges, leverage builds, rule changes tighten, and the unwind becomes violent. In 2011, silver again surged into the high 40s before collapsing, and the conversation at the time focused intensely on margin increases and how quickly they arrived. The market didn't drift lower gently, it snapped. And now, in 2025 moving into 2026, the pattern shows up again. Volatility rises, margin requirements rise, and price reacts in a way that looks like pure panic if you ignore the mechanics. This is not opinion, this is pattern. When the cost of holding paper exposure rises into a crowded trade, the unwind can be sudden. But the most revealing part isn't the price chart. It's the positioning and the infrastructure behind the price. On the delivery side, the exchange publishes reports that show who issues and who stops contracts in the delivery process. In the February 2026 COMEX 5,000-ounce silver line, the names are not small. Deutsche Bank, HSBC, Wells Fargo Securities, Scotia Capital, Bank of America Securities, Morgan Stanley, JP Morgan Securities. These are not casual participants. These are institutions that understand the rulebook like a second language. And here, S the number that sharpens the picture. Total activity on that February 2026 silver line was shown as 633. That is a specific tally in the machinery of delivery. It tells you institutions were engaged at the point where paper can become metal, even as the broader audience argued about stories. Now look at the warehouse ledger, because this is where the dislocation lives. The COMEX warehouse reporting breaks silver into categories that matter. There is eligible metal, which is stored in approved vaults and meets specifications, but is not necessarily available for delivery against futures, because it's not registered for that purpose. And there is registered metal, which is deliverable inventory tied to warrants and available to satisfy delivery obligations. On the February 3rd, 2026 report, the registered silver number sits around 103 million ounces. The combined total, registered plus eligible, sits around 404 million ounces. Those are not small numbers, but the gap between them is the entire story. The deliverable pile is a fraction of the total stored pile. That means the market can look flush in total ounces, while being tight in the category that matters for delivery. Plenty where? Plenty stored or plenty deliverable right now? Because delivery rules care about registered, not eligible. And when a paper market is shaken by margin hikes, the psychological question becomes physical. If someone stands for delivery, how confident is the market in the deliverable stack? So what is the small update that can crush paper silver? It's not a single line of code, it's the margin parameter itself, the rule that determines how much cash is demanded to hold exposure. When that number moves sharply higher, it doesn't ask whether your thesis is correct. It asks whether you can post collateral today, right now. Let's make it simple with an analogy. Imagine a crowded theater. Everyone has tickets. Everyone is watching the same show. Now imagine the theater management suddenly announces that to stay seated, every person must place an additional deposit at the door. People who can't pay don't get a debate. They're escorted out. Suddenly the crowd thins. The noise changes. The price of tickets on the street might drop, not because the show got worse, but because forced exits hit at the same time. That's what margin hikes do in futures. They are a deposit increase on participation. For leverage traders, especially those running tight cash management, it is a shock. And it tends to hit the most crowded side first, because that's where exposure is largest, and where the scramble for collateral is most intense. But the data shows something else entirely when you compare paper selling to physical reality. If the deliverable registered stack is roughly 103 million ounces, and the broader stored total is roughly 404 million, the market is structurally segmented. Paper can trade enormous notional values without immediately moving physical bars until delivery becomes a focal point. That's why dislocations happen. Paper can be crushed while physical premiums and availability behave differently, because they live in different time frames. Historically, when such dislocations widen, one of two things has tended to happen. Either the paper price continues to fall as leverage is purged and sentiment breaks, or the forced selling exhausts itself and price snaps back when the marginal seller is gone. The key is that the catalyst is not a mine output report. It is the funding condition of the paper system, and that's why the institutional movement matters. Big firms that can finance inventory, manage margin, and arbitrage spreads don't experience a margin hike the way a leveraged speculator does. For them, it can be an opportunity. Volatility creates spreads. Spread trades create yield. Delivery mechanics create optionality. If you can survive the shakeout, you can pick up positions from those who can't. To understand why a margin increase can hit like a hammer, it helps to separate three concepts that are often blended together: price, volatility, and collateral. Price is the last trade. Volatility is the speed and range of price movement. Collateral is the cash or high-quality assets posted to guarantee performance. The exchange and its clearinghouse care less about your opinion on silver and more about whether your account can survive a large adverse move without defaulting. When volatility rises, the model that estimates potential losses tends to demand more collateral. That is the logic on paper. This is also why margin hikes can create a feedback loop. A margin hike forces selling. Selling pushes price down. A falling price can increase perceived risk, keeping margins high. The forced selling can then snowball into a cascade, especially if many participants are positioned the same way. The market doesn't need to decide anything intellectually. It just follows the chain of collateral demands. And there's another layer. Futures are marked to market. That means gains and losses are settled daily, sometimes more often in extreme volatility. When price moves against a leveraged position, funds are debited. If you're long and price drops, your account loses money immediately. Now combine that with a margin hike demanding more collateral at the same time. That double hit is what turns a normal drawdown into a forced exit. So when silver was reported as sinking roughly 11% intraday around that December 29th, 2025 window, you can see how the system can corner participants. A large price drop creates losses, and a margin increase demands more cash, both in the same breath. That is how paper exposure gets crushed without any change in the physical world. Now, let's talk about the delivery mechanism, because it's the bridge between paper and metal, and it's where the most confident players tend to operate. A COMEX silver futures contract represents 5,000 troy ounces. When a contract goes into delivery, The short side can issue a notice to deliver, and the long side can stop it, meaning it takes delivery. The exchange records which firms were issuers and which were stoppers. That's where those institutional names matter. It's not just chatter about who might be active. It's a record of participation at the point where the paper claim can be converted into warehouse receipts. The number 633 on that February 2026 silver line becomes more meaningful when you translate it into ounces. 633 contracts at 5,000 ounces each is 3,165,000 ounces represented in delivery activity. The point isn't that 3 million ounces will empty the world. The point is that delivery is a real option exercised by large entities, and its very presence disciplines the paper system. If market confidence in deliverable inventory weakens, delivery demand can become a pressure point. This is why the registered versus eligible split matters so much. Eligible metal sits in approved vaults and meets specs, but it belongs to someone who has not registered it for delivery. Registered metal has the paperwork that makes it immediately available for delivery. When registered is around 103 million ounces and total is around 404 million, the deliverable portion is roughly a quarter of the total. That's not inherently alarming, but it means the system depends on the willingness of holders of eligible metal to convert it into registered if delivery demand rises. If holders refuse, deliverable supply can feel tighter than headlines suggest. Here's where it gets interesting. The market's paper narrative is often that futures are just financial instruments and delivery is rare, but delivery doesn't have to be huge to matter. It only has to be credible. The possibility of standing for delivery is what anchors the futures contract to the physical world. If that anchor feels weak, the spread between paper price and real-world availability can widen. You can see this in the way different markets signal different truths. The paper market can show a sharp decline in heavy volume, while physical dealers might report premiums that stay firm, or delivery times that lengthen, or regional demand that doesn't disappear. Even without quoting specific retail prices, the concept is clear. A leveraged financial market can liquidate faster than a physical supply chain can respond. A futures screen can change by dollars in minutes. A refinery or a mint can't retool in minutes. That time mismatch is where dislocations are born. CME also scheduled a new 100-ounce silver futures contract, effective February 9th, 2026, creating a smaller lane beside the 5,000-ounce flagship. That segmentation matters when big contract margins rise and leverage is squeezed. This is where rumors thrive. People sense that small rule changes can have outsized effects, and they assume intention. But you don't need to claim a grand design to see impact. Impact comes from structure. If the structure is leveraged, a margin shift is leverage control. If the structure is delivery-based, inventory categories matter. If the structure is global, regional flows can create tension between paper price and physical availability. Let's lay out the mechanism as a cause and effect chain. Volatility increases. Risk models demand higher margin. Margin increases raise collateral requirements. Participants who can't post collateral reduce positions. Reduced positions often means selling, especially if longs are crowded. Selling pushes price down. Falling price triggers mark-to-market losses, further straining collateral. More selling occurs. Meanwhile, physical demand and supply might not change in the same instant, so premiums and availability don't always mirror the paper move. That is how a dislocation can open. If you want to see how quickly this can reshape sentiment, consider the psychology of a trader or fund manager. They might have a thesis based on inflation, industrial demand, monetary policy, or long-term scarcity. But none of that matters if the risk department says collateral requirements changed overnight. The risk department doesn't debate a thesis in a crisis. It reduces exposure. That's why margin hikes feel like a trap to those caught on the wrong side of leverage. Margin hikes can reduce systemic risk, yes. They can also change the short-term direction of price by forcing liquidation, yes. Both can be true at once. The more useful approach is not to argue morality, but to track consequences. Now, let's revisit historical parallels with a sharper lens. In 1980, the silver market's surge and collapse showed how leverage, rules, and concentrated positioning can create a dramatic reversal. The lesson isn't the gossip. The lesson is that when participation is heavily leveraged and the rules tighten, the unwind becomes disorderly. In 2011, silver's run and sharp reversal again highlighted how quickly a trend can break once collateral demands rise and sentiment flips. The common thread is not a single villain, it's leverage meeting a rule change. And in 2025 into 2026, you see a modern version of that interaction. A margin change coincides with a sudden intraday decline. Institutional names appear on delivery reports. Warehouse categories show a deliverable stack that is much smaller than total stored metal, and a new contract design is introduced for smaller sizing. Each element alone can be explained away. Together, they form a pattern of a market adjusting its leverage and its access points at a moment of elevated demand and volatility. So what does the data suggest going forward, purely as a pattern? Watch for whether volatility remains high. If it does, margin tends to stay elevated. Elevated margin tends to suppress speculative leverage. That can keep the paper market heavy, even if long-term narratives remain popular. If volatility declines, margins can be reduced over time and leverage can creep back in. That can set the stage for renewed runs. In other words, the market can breathe again when collateral demands ease. Also, watch the relationship between nearby contracts and deferred contracts. When the front of the curve behaves differently from later months, it can reflect tightness or abundance in the immediate deliverable space. Watch warehouse changes, especially registered inventory. If registered rises significantly, it can ease delivery anxiety. If registered falls persistently, it can amplify it. Watch delivery activity and who is active. The names matter not because they are villains or heroes, but because they reflect where the strongest balance sheets are leaning. There are a few scenarios the historical pattern suggests, without pretending to predict. In a conservative scenario, the margin shock triggers a liquidation phase that lasts long enough to reset positioning, after which volatility compresses and the market stabilizes. In a moderate scenario, liquidation is followed by a sharp rebound as forced sellers finish and the remaining participants reprice risk upward. In a more aggressive scenario, a sustained dislocation between paper and physical forces, structural. Adjustments, like shifts in inventory registration, changes in spreads, and a renewed focus on delivery credibility. The common thread is that rule mechanics influence the path. Notice what's absent from all of that. There's no need for a dramatic headline. No need for a new slogan. The plumbing itself can create the move, and that's why rumors about rule changes spread so fast. People sense the power of the mechanism, even if they can't name it. And this brings us to the divide. The difference between those who get blindsided and those who stay calm is not intelligence. It's attention to the infrastructure. The wealth gap in markets is often an information gap. Institutions read the rules as closely as they read the price. Retail reads the price and then searches for a story to match it. The data shows institutions tend to move first, and the wider audience tends to react last. That's not because one group is smarter in an abstract sense. It's because one group has to care about margin, clearing, and delivery every day. But in moments like late December 2025, the technical details become the main event. So the next time you see silver drop violently, ask a different question. Did margin jump? Did volatility trigger a risk response? Did the deliverable stack tighten? Because if the mechanism is pushing traders out, the price move is not a clean signal of fundamentals. It is a signal of stress inside the paper structure. And if there's one takeaway that holds across decades, it's this. The paper silver market is a leverage machine wrapped around a physical commodity. The small updates are the levers. When those levers move, the machine behaves differently. The metal didn't suddenly change its atomic structure. The rules change the behavior of participants. This is channel name, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen, you know what to do. And remember, the real question isn't whether the paper market can be shaken by a small update. The data already answered that. The question is whether you can recognize the mechanism while everyone else argues about the story.